So, you spend decades saving for retirement, carefully building that nest egg. But what if I told you the way you plan to spend that money could actually be a massive tax trap? Yeah, that's what we're going to dive into today. For years, we've all been told there's a safe way to draw down your retirement accounts. But what if that conventional wisdom, that path everyone follows, is actually setting you up to pay thousands, maybe even tens of thousands of dollars more in taxes than you need to? You've probably heard this a million times, right? It's the classic three-step playbook. First, you spend down your regular taxable brokerage accounts. Then you move on to your 401ks and traditional IRAs, and you save the absolute best for last, your tax-free Roth accounts. I mean, on the surface, it makes perfect sense. You want to let that tax-free money grow as long as possible. Simple, logical. What could go wrong? Well, that simplicity, that's exactly where the danger is hiding. This strategy is just too simple for the real world. It completely ignores how the US tax code actually works, and it can walk you, completely unaware, straight into two major tax traps that can blow up your tax bill later in life. So what is this hidden problem I'm talking about? Well, it's a nasty one-two punch. It's something called the tax torpedo, combined with the government's forced withdrawals, which you probably know as required minimum distributions, or RMDs. And believe me, together, they can create a perfect storm for your finances. Okay, first up, the tax torpedo. And yeah, it is just as painful as it sounds. It's this bizarre little quirk in the tax code where, for a lot of retirees, taking just one extra dollar from your IRA triggers a crazy double whammy. It's not just that dollar that gets taxed, oh no. Taking it out can suddenly make 85 cents of your Social Security benefits, which you thought were safe, taxable income too. And look at what this does in the real world. You might think you're sitting pretty in the 22% tax bracket. But because of this torpedo effect, your actual tax rate on that next dollar you withdraw can skyrocket to over 40%. All of a sudden, that withdrawal you planned for costs you nearly double what you expected in taxes. It's a brutal surprise. And this is where the other shoe drops. RMDs. Starting at age 73 or 75, Uncle Sam literally forces you to start taking money out of your traditional IRAs and 401ks. And that forced income can push you right into that high tax torpedo zone, whether you need the money or not. Your control, it's just gone. So yeah, this all sounds pretty bleak, doesn't it? But it really doesn't have to be this way. Experts like Dr. William Reichenstein have shown that if you have different types of accounts, taxable, tax-deferred, and tax-free, you can actually play this game way more strategically. So the big question is, how? Okay, strategy number one is called bracket filling, or sometimes income smoothing. The whole goal here is to stop thinking about minimizing your taxes for just this 1 year and start thinking about minimizing your taxes over your entire lifetime. Here's how it works. In those early retirement years, before Social Security and RMDs kick in, your income is probably pretty low. So instead of paying zero tax, you do something that sounds crazy. You intentionally take out just enough from your traditional IRA to fill up those super low tax brackets, like the 10% and 12% ones. You're choosing to pay a little bit of tax now at a really cheap rate to shrink that IRA balance and dodge a massive tax bill later on. Let's just look at the numbers. It's pretty amazing. With the old school plan, a couple might pay next to nothing in taxes for a few years. Awesome, right? But then look what happens. Bam! Their tax bill shoots up to over 12 grand a year. But with strategic bracket filling, they choose to pay a little more upfront, say $3,000 a year. But the payoff is incredible. Their tax bill later in life is almost cut in half, which leads to huge lifetime savings. $63,000. Just let that sink in. In this one example, that simple, proactive shift saved this couple 63 grand over their lifetime. That's the real difference between just letting taxes happen to you and actually taking control. All right, on to the second powerhouse tool in your kit, the Roth conversion. Now, just like bracket filling, this is all about being proactive. It's about choosing to pay taxes on your own terms when the rates are most in your favor. And just like before, that magic window is in your early retirement years. This is when you can convert a chunk of your traditional IRA over to a Roth IRA. Now, yes, you do have to pay income tax on whatever you convert today, but you're doing it while you're in a low tax bracket. In return, that money now gets to grow completely tax-free forever. And, this is key, it is no longer subject to RMDs. So what does this do to that nasty tax torpedo we were talking about? The impact is just massive. If you follow the old rules, A retiree could end up seeing more than half of their Social Security benefits get taxed every year. But by strategically doing Roth conversions, they can knock that taxable portion all the way down to just a third. It's like diffusing the torpedo before it even gets close to your boat. And the result? Another huge win, a lifetime tax savings of $44,000. Just by paying some tax at a low 10 or 12% rate early on, this person completely avoided paying that punishing 40% effective rate later. That is what smart tax planning looks like. And finally, let's talk about legacy. These strategies aren't just about making your retirement better. They have a huge, huge impact on what you can leave behind for your family. This is all about maximizing the after-tax value of your estate. Okay, there's a key concept you need to know here. It's called the step up in basis. When you leave assets, like stocks in a regular brokerage account, to your heirs, the tax clock basically resets. All those capital gains that built up over your lifetime, poof, they're just wiped away, totally tax-free for your kids. But, and this is a huge but, that step up does not apply to retirement accounts. If you leave your heirs a traditional IRA, they get a tax bill. They have to pay ordinary income tax on every single dollar they take out. It's treated just like a paycheck. But if you leave them a Roth IRA, they get every single penny, 100% tax-free. I mean, the difference for your legacy is just profound. So you see what's happening here? The old conventional wisdom of just passively spending down your accounts in a simple 1, 2, 3 order, it's just outdated. The modern approach is to become the architect of your own withdrawals, to proactively manage your income and your taxes all the way through retirement. Okay, so let's tie this all together. The single biggest takeaway is that the safe, conventional plan can actually be a tax trap. Your golden opportunity, your sweet spot, is that window of time between when you retire and when those forced withdrawals, the RMDs, begin. That's your time to make these strategic moves. You can coordinate them with when you decide to claim Social Security, and you can even think ahead to your heirs' tax situations. It is all about being the architect of your own financial future, right down to avoiding those nasty little surprises like Medicare premium spikes. When you really think about it, the tax code is just a set of rules. For way too long, most retirees have been playing the game on defense, just reacting to whatever comes their way. But by understanding things like the tax torpedo and using powerful strategies like bracket filling and Roth conversions, you can finally go on offense. So the real question is, now that you know the rules, how are you going to play the game?